I always tell our first lecture of the year at UCT is always around, tell me what the transaction you can think of that doesn't have a VAT implication. Either you've got to take a view as whether it's zero rated, standard rated, out of scope or whatever. But because of the very wide ambit of the charge to tax in the first instance, you have to take a view around VAT. So the fact that you're going to have a cross-border transaction and you think it's involving non-residents, it should be zero rated. Well, you need to at least do the thoughts behind it, and how do you get there? So I'd like to start off with some general principles. There's an assumption here that you guys know what input tax is, which is the value-added tax you pay on goods and services that you purchase, and output tax is the VAT you're required to account for in relation to your suppliers. And the difference between the output tax and the input tax is the amount that's payable to SARS, or alternatively is payable to you by SARS, although that tends to take a bit of time. So just see if I can get this going. There we go. Okay, so now we realize it's quite slow. Okay, so one of the most important things to realize about value-added tax is there's no statutory right of recovery. Okay, so the way you've got to recover your output tax or the VAT you're going to have to account for is a contractual basis. The only statutory right of recovery of value-added tax is when you become a vendor for the first time, or alternatively where there's fraud or there's misrepresentation, then SARS can in fact raise the necessary assessments to claim the value-added tax. But otherwise, you effectively have to have a contractual right to the value-added tax. And there's always been this idea, and certainly one that's pushed by the accountants. If you look at their accounts, they'll make out like VAT's not a charge on the vendor. Somehow it's not that vendor's income, so that sits outside in a VAT account and that sort of stuff. So I'm very thankful to Mr. Parker, who stole value-added tax, and SARS went after him, and not just to recover the tax. They then thought it'd be, and there's criminal sanction in the VAT Act for evasion, things like that. But anyway, for some unknown reason, they decided to charge him criminally for theft. And there the court said, like there is no, you're not accounting for VAT as in a trustee relationship or some fiduciary capacity or agency relationship. It's your money, so you can't steal it. So for me, it's indicative once again that it's nothing other than a method of determining what your liability is in your part of the distribution chain, production distribution chain. But it's your liability. And it's that you only have, as I say, have a right to recover it from a contractual basis. So you have to make sure that all your contracts talk to value-added tax. And I've set out there one of the few situations where you're not liable, the recipient becomes liable, but that's very limited and haven't seen much of that in practice at all. Now, if you look at VAT in other VAT jurisdictions, you'll see that they place supply rules. It says that if you make a supply in New Zealand, in Australia, in the United Kingdom, in Canada, whatever, all the English-speaking ones that I've at least had a look at, and then there are places supply rules that said in what circumstances that supply is regarded as being made in that country. Now, we don't have places supply rules. One of the only VAT jurisdictions I've come across that doesn't. And just a bit of history quickly. And the reason we got that, and the reason we have references to vendor instead of taxable person, as in all other jurisdictions, and we have an enterprise as opposed to a taxable person, is because we moved over from a sales tax to a value-added tax system. And when we did that, we tried to keep some of the concepts or the names and nomenclature the same. So we had vendor under sales tax, we had enterprise under sales tax, and then we incorporated that. So to become subject to VAT in South Africa, you have to carry on an enterprise. An enterprise is very broadly defined as any activity or enterprise carried on in the Republic, wholly or partly in the Republic, in the course of furtherance of which goods or services sold for consideration, and whether or not for profit. So, we often hear people saying, "No, but it's a donation." Well, donation can be consideration for a supply. So one needs to be careful about that. There's a specific exclusion for association start for gain, but otherwise, with the fact that it's a voluntary payment you've made to get something, you didn't have to pay for it, but you decided to pay for it, makes it taxable. And then we have, in recent years from 2014, gone full scale into the taxation of e-commerce under value-added tax. One of the first countries in the world to do that. And later on, we're going to be spending some time looking at that e-commerce situation. Okay, so what we have here is specifically, so one other thing we don't have is a situation where a branch is defined as a separate person for VAT purposes or for VAT purposes. What we do have is an exclusion where we have any branch or main business of an enterprise permanently situated inside South Africa is deemed to be carried on by a person separate for the vendor if the branch meets certain criteria. One is they must be separately identifiable, and then they have a separate books of account. Now, in Wenca International Mining Systems, they had established a branch in South Africa that rendered services only to Wenca. In other words, Wenca had contracts with various mines here, and their local branch would service that contract, but for on behalf of Wenca sitting offshore. Now, the question was could they rely on this then to register Wenca as a separate person and therefore a separate VAT vendor, or did they have to register Wenca International Mining Systems, the corporation? So I said, no, you can't register the branch, and the court agreed on the basis that the only services supplied was to Wenca. And on that basis, the branch itself couldn't be said to be carrying on an enterprise because you have to make supplies to another person and you can't make supplies to yourself. So that's very important to bear in mind that, so many people, when they do cross-border and they establish a branch in South Africa, they think, oh, we'll just register the branch. But you've got to look at the activities that are going to be carried on by that branch. And those activities must be, those supplies, there must be supplies that are rendered to third parties. You can't have a branch in South Africa that you're going to register as a branch, and then just, if it's only rendering services or to the main business, payment and an invoice. Importantly, an invoice is any document notifying an obligation to make payment. That triggers your liability to account for value-added tax. And what's important here to bear in mind is that you could have a sale agreement that could constitute an invoice. It's a document. And unless there are, conditions attaching to the effect of the contract, that some approvals have to be given. But if it's just, I'm going to sell you a building for 10 million Rand, thank you very much, I'll buy your building for 10 million Rand, and you sign a contract, that is an invoice that triggers a liability to account for that. Okay, I've got to start looking first at the supply across border of goods. Now, we probably all know at this stage that goods exported from South Africa are zero rated. The important thing to bear in mind is that there are two types of exports. One is what we call direct exports, and that is governed by effectively the administration. The requirements are governed by Interpretation Note 30. And then we have indirect exports, which are governed by Government Notice 316. And then there's also an export where goods are consigned because a branch, remember, branch main business, you're still one and the same legal entity. So there's a general definition of what it is. The supply of this exported goods. The supplier supplied the goods in terms of a sale or installment agreement, and the supplier has exported the goods in circumstances contemplated in paragraphs A, B, C, D. We're only going to be dealing with A and D because those are the main ones that we deal with. The first one is what we call a direct export. That is where it is consigned or delivered by the vendor to the recipient and addressed in the export country as evidenced by documentary proof acceptable to SARS. So often that's overlooked, and this is happy hunting ground for SARS, because what it's saying is if you don't have this documentary proof that is acceptable to SARS, you don't have zero rating. This zero rating doesn't apply if those services are rendered directly in connection with land or movable property that is situated in South Africa at the time the services are rendered. That's the first exclusion. But there's two exclusions to that exclusion. So those exclusion to an exclusion will get you back into the zero rating. So in those circumstances where the goods in respect of which you've directly rendered your services, those goods are going to be exported to the recipient after you've rendered the services. Now, can we say that that company is in South Africa, by virtue of its employees being here. Now, SARS in a very old VAT ruling held that, yes, if there was somebody in South Africa who was receiving that service in a sense, then you're not allowed to zero rate it. So I'm going to make the distinction here. So they looked at it and said, okay, how do we deal with e-commerce? At that time, they had place of supply rules that says where you rendered services across border, then the supply was deemed to be made where the business was carried on. In other words, if the business was carried on in the UK and it supplied e-commerce services to somebody in South Africa, there wouldn't be any VAT on it in South Africa because the place of supply would be in the UK, and then they would do a test there. What they decided was that what you needed to do is throw out that rule and adopt the destination principle. And effectively, the destination principle imposes tax in the jurisdiction where the consumption takes place. Because remember, value-added tax is an indirect tax on consumption. So they were saying tax it where the consumption takes place, as opposed to the origin principle, which is where the supplier is. Okay, so they said use the destination principle in relation to e-commerce, and that's what they in relation to intangibles and internationally traded services. Intangibles should be taxed according to the rules of jurisdiction of consumption. Now, what the guideline did was it draws a distinction between business to business and business to consumer suppliers. Now, business to business, they're saying if you have a reverse charge in the country of where the customer is situated, then don't tax it because it's business to business, and the person in that country either would have been entitled to an input tax deduction if they were wholly engaged in making taxable supplies, or alternatively, they would have had to account for value-added tax on this reverse charge, which in South African context is our imported services, and we're going to deal with that in a minute as well. So they said if you got a reverse charge, which we have, don't tax B2B, but tax B2C. Okay. So that's what the rest of the world has done. And once again, to be different, we don't have place supply rules, and just to be different, we didn't adopt that distinction. And I remember being in workshops, lots of workshops with SARS, where we begged them to bring in this thing, to say that you're wasting time, you're going to have to register all these guys offshore. And really, it's B2B. Everybody would have been entitled to an input tax deduction. If they're not, they got imported services. It fell on deaf ears. The only concession they made was to bring in this, as we'll touch upon now, an exclusion on where they're group companies. And that itself has raised any number of problems. I will not be lying to you if I don't say to you that since the start of the year, I've had 5 companies that will, as we'll see in a minute, are providing electronic services to South Africa and should be registered. And they're saying, but we're not registered anywhere else in the world. Why would we need to register here? And it's only because we don't have a B2B exclusion. So that's very important to bear in mind if you're dealing with somebody who's providing you with electronic services, and we'll have a look at that in a minute. Okay, so how did we do it? As I said, we were the forerunners. I think we were the 5th country in the world to introduce specific VAT rules around services that were provided across the internet, effectively. So in June 2014, we introduced it, and I said no B2B distinctions. But what they did was they brought in categories of services. So it wasn't just all services. They defined the services. And if you looked at the services that were defined, you would see they were very consumer-orientated, not business-orientated. So information services, for instance, was not included. Originally was taken out. So a lot of the stuff was sharing of music, books, etc. And so it was defined. What in fact SARS did was they brought in all services effectively. So where are we now? From April 2019, there are no longer any categories of electronic services. It talks about any services supplied by means of electronic agent, electronic communication, or the internet. Then the next question that comes up is there no provision where you can register, somebody else can do it on your behalf? I haven't dealt with it yet because it's tricky, but I'm just going to mention it. There is a regime that talks about intermediaries. So an intermediary is somebody who collects and invoices and collects money relating to electronic services. They have to account for it, but not if the non-resident has to be registered for value-added tax purposes. then the fact that you are a vendor, in other words, you're making taxable supplies in the course of furtherance of your enterprise that exceeds the registration limit, you can't say, well, I'm not going to account, but this intermediary is. It doesn't work that way. And I've come across people who are arguing that, but we can have an intermediary regime where I don't have to register offshore. It doesn't work that way. I'm telling you now, folks, it doesn't work that way. It's a reverse charge mechanism. And if you're dealing with non-residents, before you get to explain imported services, explain to them it's a reverse charge. That will make far more sense to them. Okay, so the latest thing is, but the bank has to account for value added tax. So why do I have to register? Okay, importantly, there's an exclusion that says if it's electronic services that is subject to VAT, then there's no liability to account for imported services. So if I'm supplying electronic services to the bank and other banks and other people that I'm not wholly engaged in making taxable supplies, yes, they'd have to account for output tax and imported services, except if you've exceeded the registration threshold, and you should be registered and you should be charging value added tax.